Welcome back to Professional Punters. I'm Lee Hong. Today I'm joined by Ting Wu. Ting spent his early career in quant trading, first at Weiss Asset Management, then at Jane Street, then at 5 Rings in New York City. Then he made a hard pivot out of trading entirely and into climate tech. He's now a founding machine learning engineer at Coolant, which just raised from General Catalyst and Floodgate to build spatial intelligence and 3D vision for climate. What I want to get into is that pivot, what it is like to leave a desk where the feedback loop is measured in seconds and to go build something where the payout is years out. This episode is brought to you by Freeport Markets. Freeport gives you 24/7 access to stocks, indices, commodities, and crypto with up to 50x leverage, including weekend trading with no KYC. It also tracks the feeds you actually follow on Twitter, Substack, hedge fund, and insider filings, and uses AI to connect the dots and flag the catalyst ahead. Download Freeport today on the App Store or Google Play. As always, leverage cuts both ways, so never trade more than you can afford to lose, and nothing here or following constitutes investment advice. Always consult a registered financial advisor before investing. Anyways, let's welcome Tim and let's get into it. Cool, welcome to another episode of Professional Punters. So today we have Tim with us.
Hello.
Tim's worked at Jane Street, Weiss Asset Management, and 5 Rings, so a lot of firms. I think, for a lot of our listeners who are kind of not into kind of the hedge fund or prop firm trading, I think it'll be pretty informative to kind of get an idea of what actually goes on at some of the most sophisticated firms in the world.
Yeah, definitely. I can talk a little bit just like about the differences between these places, like sort of what my experience is like.
That makes sense. I think, do you want to maybe start talking about like, what were some of the roles you had at these firms, like basically what desk you were on, or like what team you were on at each of the firms, and maybe how to conceptualize some of the differences?
Yeah, definitely. So I interned, the order that I was at these was I interned at Weiss and then at Jane Street and then I went to 5 Rings full time.
Yeah.
And sort of going into it, I had like no idea what any of these places were like. I actually had not heard of Quant until I applied and interviewed at Weiss. But basically because it was a hedge fund, there was one quant desk at the firm. Yeah. And it was much more traditional, much more TradFi hierarchical structure. Mm-hmm. And so that one quant desk just did everything statistical. And so it was also it's a hedge fund, right? It's not a market maker. They're literally trying to just find edge. Yep. They're just trying to find statistical edge. And then somewhere like Jane Street, which fundamentally is pretty similar to what 5 Rings was doing, just sort of at a larger scale. It was much more just market making, right?
Yep.
And so they're not trying to make many, maybe a little bit, but they're not trying to make many directional bets.
I think maybe a little bit, especially now. I think I've heard it.
Or the story, the story is they're not trying to make any.
That's supposedly for their market maker privileges, they're not supposed to make directional bets. Yes.
Yeah. Right. So then it's less so about finding this directional edge, and it's just purely market making, right? And then similar at 5 Rings. I think in terms of what they're trying to do strategy wise, it's it's also a market maker similar to Jane Street, but obviously it's a much smaller shop.
And what kind of I guess in terms of day-to-day differences do you think exist at these firms? Is there a big difference in terms of what you're doing every day, other than kind of the hierarchical structure at a traditional firm versus maybe a flatter structure at the prop shops?
Yeah, definitely. It's very much I think there's a varying degree of just doing whatever you want to do. Mm-hmm. I think that at a hedge fund, for one, it's much more of when you start, you're reporting to someone, it's you have whatever project, you're just doing this one thing. And then for somewhere like Jane Street, at least for what I understand full time, it's there's a lot more freedom, right? With any of these more flat places, it's sort of just if you think there's a good idea, you can you can go pursue it with much more liberty than you could at a more of a quant hedge fund type place.
Yeah, that makes sense.
And then similar with something at 5 Rings, it's again, it's not you can just pursue it. If it's a really dumb idea, you can't just pursue whatever you want.
What are some dumb ideas that potentially, have you heard any dumb ideas?
Of course.
Oh wait, what are some dumb, because I think a lot of people, when especially when they first think about quant trading firms, these are some of the smartest people on earth, but I think there's still people, and then sometimes there are some pretty stupid ideas that comes around.
Of course, yeah. Okay. Let's think about, I have some like dumb, but probably not that like interesting dumb ideas.
Okay, fair. Or some examples, maybe.
Yeah. I think there's like a lot of like, I think there's a lot of dumb ideas like STEM, like, oh, actually, the best dumb idea, great lesson, I think, is the idea. I think that I'm sure a lot of quant firms are still in like falling into this hole where they're like, oh, like AI has no place in the markets. I think the dumbest thing you can do as like a quant shop is just like not really spend effort exploring this.
That makes sense. Yeah.
Right, where it's like, oh, like just purely from like a like, I don't know, like if you look at just like the distribution of like all possible outcomes, like it's a very low cost to like, I don't know, like hire some cracked PhD people to just like go and, you know, just give them a bunch of money to go explore this. And if you don't, it's like you're like now, like you're probably like losing now, right? It's like you're just being competed away.
Yeah, I think if you look at like HRT's most recent earning, it's like their like profit per head is like almost maybe the same or even higher than Jing's. And like Jing definitely, you know, they just built a data center. Or like, you know, this.
Yeah, it's very clear they're going after this like hard now, right?
It's very clear it's this like hard deep learning thing, because like any other traditional method, you will not need like a data center for your compute.
Yeah. Yeah, and I think I heard this narrative so much when I was like going through quant like very early, right? Especially at the hedge funds where they were like, oh, like, you know, signal to noise is just like too low.
Yeah.
Like there's just like the distribution shifts are too high. Like you can't really isolate, like, you know, there's too many active players. It's too like game theoretic, whatever. And like, yeah, it's like, I mean, all those people were very clearly wrong now.
That's true. And I guess maybe if you're able to talk about a little bit about some of the particular strategies, or like maybe just like a high level, basically what was the dislocation that, you know, people were taking advantage of, and what were, you know, maybe some of the particular projects that you worked on?
Yeah, sure. When I was like at Jane Street, actually our desks were right next to each other.
We did sit next to each other at Jane. Yes,
yeah, that's how we met.
That is how we met. Yes.
Yeah, it was a great summer. But yeah, like for example, like it's like I'm sure like everyone's like very familiar with like, oh, like efficient markets, right? Like it's very difficult to get at like alpha in like just like trying to understand like prices better than other people understand prices, especially in more liquid markets, things like that. But for example, like one thing that you can probably like model well and is something like volume patterns, right?
Yeah.
And for a firm like Jane Street or any of these other shops that's market making, like this is like incredibly important information to have modeled well, right? And it probably is worth it. Like if you try to like predict where price is gonna go, like it's probably not worth your time like doing some very like direct prediction, especially more liquid markets. But like for something like volume, it's like, well, like this tells you like how much slippage people are going to have when they trade. This tells you like, you know, it's like what should you be putting on the books? Like how much risk should you be willing to take on? It's all these very important things. And because it's from a very like direct perspective, there's no like efficient, there's no like efficient like reason that people want to compete this away. Like this is actually very valuable for you to sort of try to model out. If you're in retail, this is probably like not as important for like probably don't really give a shit.
That makes sense.
But yeah, like that's an example of like one thing that's probably like worth your time like modeling at these.
That makes sense.
Yeah.
And then what about maybe a 5 rings or Weiss, I guess?
Yeah, I can speak a lot less about 5 rings.
Fair. Okay.
And also Weiss. To be honest, I'm not entirely sure what their NDA policy is because I was young and did not read those things.
That makes sense. That's all good.
But like yeah, it's like I guess like what's like generally like pretty public, pretty known about like a place like 5 rings, where it's going to be like a pretty similar like very quantitative trading style, right? Like a quantitative like market making type approach, and it's like it's sort of like a given for a lot, like how a lot of these market makers are getting their edge, right? Yeah. Like it's the same, like it's just similar strategies. It's like, oh, how well can you like model like the risk you're taking on, like the edge that you're getting for like the different like trades, whatever the size you're taking on, just like modeling, you know, like whatever like prices relative to fair values, whatever like amount of vol in your positions. Like this is something that like if you start at like any quant firm, like they'll teach you within like the first month.
This makes sense, yeah. And I think a lot of times like stuff like, volume, like you said, because I think, when you were working on the volume modeling, I was working like realized volatility, decay modeling. Whereas like, like there's like surprising applications for like being able to model these things really well. I think to our like listeners who, may not kind of, understand this, like the idea is basically, options, their value comes from the expected realized volatility of the underlying, because you can kind of like delta hedge an option and then basically get exposure to, the underlying, like by delta hedging the option can get rid of the risk and then just get the exposure to volatility. And then like, the volatility doesn't realize linearly, like it realizes, more in the morning when there's more trading and more volume, and then also more at close. But then for certain things like, futures, like oil that kind of trades throughout the day, this schedule is actually somewhat important because a somewhat surprising application, I guess, for my like volatility modeling was like certain stocks at open, you're supposed to like decay more of their vol versus other stocks. So like one example is like Chinese stocks, obviously, like you're supposed to decay, more vol over Chinese hours than like US stocks where like, there's relatively less trading. And I think like, is there like maybe something like volume where like there's kind of this sort of like application to, I guess, like pricing or actual trading like directly that like makes sense?
Yeah, definitely. Like for example, like you were talking about like oil earlier, right? For example, with any of these like commodities, where it's like there's these these like expiries every month. It's like there's actually like pretty predictable volume. It'll come from things like, oh, is it financially settled or is it physically settled? Because like nobody wants to take delivery of like oil, right?
This is true.
Like it's like there's gonna be like, and if that's the case, like no one's gonna wait. Like no hedge fund is gonna be like, hey, we're gonna wait until the last day and like potentially get screwed over when like you're taking on way more variance. And so like obviously like you can expect volume to like drop for whatever futures like right before expiry, right? You can expect them to peak like probably a little bit before that as people are like let's just say like your futures are like a little bit over a month out. Right? Like you can expect people are going to be rolling, right? Like no one wants to take their like no one wants to hold till settlement. Like people are probably going to be rolling their perps into like the whatever like the back month is. And so like there's like pretty predictable like volume patterns here. If you look at just like the months, like this is also like I think like generally pretty like well known among like all like commodities like quant like shops. It's just like there's very different like volume trading for different assets like based on the month, right? For some like it's very seasonal, like for a lot of crops or things like that, or exactly for nat gas, right? Because it's just like the winter demand. It's very seasonal. For some things it's like, oh, like for oil for example, like if something's very far out, they're probably only trading the like June, the Decembers, just because it's like you don't really care about that level of granularity. Like no one's trying to predict that level of granularity, and as people pile on to like one whatever like expiry is, it's just going to snowball, right? You're going to trade the liquid one.
That makes sense.
And all these things are actually like quite predictable, or at least somewhat predictable, and so it's like very valuable to understand all these different patterns and like model them well. Yeah, even so much as like understanding like holidays, right? Like you gotta know, like if you're trading Brent, like you gotta know like the Europeans are like always on holiday, right? Like when it's like
the Europeans are always on holiday. Yes. That makes sense. Okay, so any, I guess maybe like a review of the experiences at these places, and maybe you have a what's the thing where you can't say bad things about them?
An NDA?
No, wait. That's like non-disclosure,
the
name, the term.
I know what you mean. I can't. You can't
say negative things about the firm.
Yeah. There's no solicitation. There's no whatever the other.
And then there's no I forgot what's called.
Like you can't slander them, basically.
Oh, you can't slander them. Okay, but I guess obviously you love all of your previous employers.
Yes.
So
they're so incredible.
They're all incredible companies. Yes. Given that, which one do you like more? You obviously love all of them. Is there a relative ranking between very close, competitors?
Yes. Among all of these places, which I definitely love a lot, I think that like just from a culture, like the cultural standpoint, where I think it's like very well set up for success. This is probably the obvious answer, but I think it was like Jane Street.
Fair enough.
Like I think it's like an incredible like culture where it's like very. First of all, I think like they're very good at I think just like generally like bringing out like talent, right? They're very good at convincing like talent to join. maybe not as good at convincing talent to stay, but it's a problem that all of these shops are having, right?
I guess their competitor are the frontier AI labs, where
exactly.
people's
It's
stocks have literally
exactly.
1,000x.
Yeah, every firm is cooked in comparison to that.
Yes.
And I think it's also just like they're very intentional, I think, about how their employees are feeling, about just like the culture that they're creating in the firm. And it's just like very obvious that they have people that think about this like very hard, like all the time. Okay. And this is not necessarily the case at like every other like firm. And I think it's like a lot, like everybody who has like founded these firms at the top of these firms is all like incredibly smart, right? They're all like trying to like allocate like resources to like optimize, like, oh, like how much should we value like our like employee, like
that makes sense.
happy, like the employee experience, things like that, right? And I think that like it's very difficult when you're at the top to like allocate this correctly, because it's like you're not. It's very hard for you to get like good, honest like signals.
Because people won't tell you what.
Yeah, right. Like if you're the CEO and someone's like, "How are you feeling?" Be like, "Oh, this is incredible." And so I think it's just like a lot of firms probably underallocate for certain. Like there's these biases that I think that these people at the top, even though they're very smart, I'm sure they're thinking about it. I don't think they're correcting for it properly. And I think Jane Street's like done a great job of this.
Okay, I see. And I guess also they're very forward with the AI stuff compared to a lot of other firms. I think they were a major investor in Anthropic, right? So like they definitely had conviction.
Yeah.
Somewhere.
Yeah, definitely. I think from the perspective of like a quant firm, right? It's like just because they've invested in Anthropic does not actually mean anything about their conviction in it.
That's also true. Right. I mean, they did it quite.
But I don't know. I obviously like I have no idea like what, so I can't speak on that.
That makes sense. I guess for like maybe like if any of the listeners are like in college and thinking about recruiting for either prop shops or like hedge funds, do you have like having been at both? Which one do you recommend for what kind of people?
Yeah,
like just recruiting maybe.
Yeah, definitely. Okay. This is what I think that actually, even though this is probably something that I'm sure they're hearing a lot, I would recommend.
Maybe for context, I think we have to note that you are from a target school for these firms, right?
I'm somewhat, I guess. Yeah.
You did graduate from Stanford.
Yeah. I did go to Stanford, where actually the quant scene is like not as big as it is at other schools. Like I think that even like clearly like a lot of the like the Ivies, like the MITs and the Harvards have like a way larger presence, and even like something like Berkeley, I think there's like a larger presence.
Okay.
But I think from this actually
something like Berkeley. I'm joking.
No, like Berkeley is like a huge,
it
has a huge presence in like all of these quant firms, right? I would say that like this is at least how I am. It's like I don't think that when you're thinking about this, it's like what is like the pay gonna look like at a quant firm versus like
until you see the pay.
Versus like at a hedge fund. You're all gonna be getting paid like a insane amount, especially when you're in college. It's like, oh my gosh, these numbers are like
infinite money.
Yeah, these numbers are huge, right? And I think your decision should like weigh this very, very small. Because in the grand scheme of your life, I think all of these numbers are like on expectation, like not gonna be that big. I think one, it's like if you're interning at these and you're trying them out and you're like bored of it, it's like you're probably like you should like price like the value of like your boredom like probably a lot higher than, or I guess like a lot lower in this case, or a lot like place a bigger magnitude on it than than most people currently are, right? Or like whatever like career paths.
That makes sense.
And then the other side is it's like I think a lot of these like places that you're encouraged to go to. Like there's like a few like set paths, right? It's like, oh, you can go into like whatever consulting,
investment banking,
exactly, right? Like whatever.
CS, yeah. Well, CS is kind of dead now.
Yeah, but I think that like for all of this, it's like I think you need to understand like your own archetype and like what like path this is like setting you up for. Like people don't actually say this because they think that like these are like the most like the best careers for you to go into, right? It's because these are the careers that are like opening different like doors to like different. It's like what are you going to learn at each of these? And I think that's like by far the most important thing. It's like what are you going to learn in like are you planning to stay in like traditional finance? Like are you planning to like climb the corporate ladder? Is that something like you like want to do? And like if not, if you don't like do you just want to like make money for 5 years and coast? If you do, like, yeah, you should probably go into quant. If you love trading, or if you want to do that, it's probably like the only two good reasons I can think of right now to go to quant.
Yeah.
If I could go back, I actually wouldn't have.
Okay.
Because I think that there's like at least like in my opinion, there's just like a lot, there's like so much exciting things going on right now. Like if you're in college, like it's still like, I'm sure people are saying like, oh, it's like late, right? Like you're late to it. Like I don't think that it's like necessarily true. Like, yeah, like you're late to like this way.
Speaking of people thinking about being late to stuff, I'm just saying, Micron was able to go from a $250 billion company to a $1.2 trillion company.
Exactly, right?
So I think people need to let their imaginations, go a little bit to understand how big things can truly get.
Yeah.
We're really late.
Yeah, I think it's like there's like so much happening in like, so like AI has created so many different niches, right? Yeah. And I think it's like really
NVIDIA. When it was $1 trillion, we were like, no way, this could be a $5 trillion company.
Like, dude, retail was like was a very, very right.
Retail's right, so bro. Retail's right.
Yeah. But yeah, I think that there's just there's so many doors that have been opened that like people did not see like 5 years ago. And I think what this speaks to is that like people are really like when you go on a lot of these like higher risk like paths, it's like people like don't really understand like variance very well, right? It's like we're very like I think biologically we're like very not tuned to understand variance. Because there's like a few components. There's one like component of this like known variance. There's this like known variance, right, which we can like sort of price like kind of well, and then there's this like unknown variance, which is like variance of things that you sort of like can't foresee. And we're like incredibly bad at pricing this.
And yeah, I think that is true. And also I think people are, speaking of variance, I think especially short-term variance as expected to as opposed to expected value of something. Over the short term, kind of the variance is almost always going to outweigh the EV. But I think as anyone who trades options understand the variance that adds to the power of the square root, while the expected value, if you're making decisions independently, that's linear. So it's like kind of over the long run, it kind of, this is something I also kind of believe. It's just like over the long run, let's say over 20, 30 years, people do eventually kind of usually get to, where they need to be.
Yeah, definitely. Wait, I actually think this is like one of the, like, maybe I won't say one of the most important rules, but this is an extremely important rule of life, right? That like variance like adds in this square root fashion, right? And that means that like as long, like if you take like a lot of independent bets, like it makes a lot of sense to stack these, right? And like one thing we were actually talking about earlier is like how like this means like you should tie your portfolio, like your trading portfolio into like sort of like the life risk that you're taking, right? Where it's like, if you're like the type of person, like if you are in like whatever like AI space and whatever startup spaces, then you are entering this knowing all the risks and understanding like the amount of variance, and also like a large part of the reason that people go into this is because like there's a lot of upside like associated with this variance, right? But it's like if you're willing to take this on, and then you also have all of your retirement money in like the S&P or something, it's like there's like an inefficiency in your life, right? It's like you have you're taking on all of this risk, and like you as a person are like willing to take this on. It's like, well, you should like very clearly be taking on this risk in your portfolio, right? Like you should be levering up.
And also the two is like not even that correlated, because like, I mean, or like there's some correlation, but I think it's like relatively low for most people, like. Because the covariance is high, but like the variance on like the individual is so high that the core.
Yeah, sure.
Like in the term, we don't have that on the board right now, but we could put it up.
But like absolutely right. Where it's like I'm a big fan of leverage in general.
Dude, we're at Freeport. We're also big fans of leverage.
Yes.
What do you want me to talk about? What do you think the optimal leverage is, and how to maybe conceptualize kind of that idea? And what instrument does it make the sense the most to leverage in? I guess it will be something like the S&P or like a total global stock portfolio or something.
Yeah. Well, I think just leverage all of it. But like anything that's like very like high enough EV with like, which like taking this like square root variance reduction, you're saying like, oh, like over the long run, over like whatever next 30, 40 years that you're going to hold this, like it just makes a lot of sense to leverage it, right?
That makes sense.
I would actually, this is so easy now that like everyone can cloud code, right? It's like, I think it's so easy to just cloud code something where you just like Monte Carlo this or something. Like it'll like, you can like literally one shot it now with
this
like,
is
it's
true.
insane,
this is
right?
True, yeah.
And like sort of understand like in your like PAs, like in your personal like investments, like what, if you're at different leverage amounts, like what is this distribution of potential outcomes going to look like, right? Like how okay are you with all of the different percentiles?
Oh, I see. That makes sense. Yeah.
And you can like tune this like very specifically now, like very easily, even if you like know nothing about coding, right? And so I think this is like an like extremely worthwhile thing to do. And then you can like personally determine like what is like the best amount of leverage for you. I think there is something to be said about like leveraging like S&P makes sense. Like hold it at, like in addition to that, leveraging like slightly like different like stocks,
other
whatever,
things,
right? It's like
sense.
smaller caps, more global things. Like I just like leverage the shit out of all of it.
A crazy stat on how much the 3x leverage TQs. Okay, TQQQ.
Oh my god.
TQQQ was listed in 2010. How much do you think it's up max time? This is just like leverage.
2010 would also be a really good time to enter.
Yeah, right after 2008. Yeah, let's say like basically like how much do you, and like for reference, the normal QQQ since 2010, it is up. Let's see how much. It is up from 44 to 720 is the normal QQQ.
Wow.
So 720 divided by 44. Normal QQQ is up 16x. How much do you think TQs are up?
I actually don't think the answer is like that much further from 3x as people think. Like I would guess that it's like at least 2.5x is my guess.
So it started at 0.2 and now it's 77.
Oh.
So it has 358x because of compounding.
Oh my gosh, wow.
Yeah, yes.
Yes,
Yeah,
like case in point, right? Case in point, right? Like it's insane. And it's like obviously like there's a limit which you will see as you simulate your cloud code. Like you run your cloud code like Monte Carlo simulations, right? Where it's like if you like for example, if you leverage like I don't know, like some ridiculous amount, like you can there's the tail risk becomes very real.
It's very real. It's like if you're 10x leverage, you'll probably lose all your money at some
right? It's like
point,
the very high P that like you go to zero.
Yeah.
But it's like you just have to like figure out like what are you willing like for that to be. Like,
yeah, 700x. I think maybe like the other point I think to leverage that we didn't really talk about is potentially like if you think about all your future income that's not yet invested. Right, kind of your future income, let's say like, I don't know, especially like, let's say you just graduate college in like 2010, I don't know, you don't have that much money, like your current net worth as a percentage of your expected like entire life net worth is like basically
it's
nothing.
like nothing.
Basically
it's
nothing.
Exactly.
So like, I don't know, let's say, even if it's, let's say 1%, which like I think is a little high since, you know, your peak earning power is later. If you 3x leverage 1%, you know, like you're still only invested in 3% of your total expected natural net worth. So it's like not a crazy decision. Yeah.
Yeah, no, I like totally agree. Whereas like, especially like speaking to anyone that's like I don't know, like is interning or has offers at like something like a, you know, like a traditional finance, like at a quant shop, something like this.
Yeah.
I think you should like act as if you have like an infinite call option, right?
True,
on like it's like a bet on yourself, right? Like to be like you should like live your life as if you have this like infinite call option of like, oh, you always have the option to like go to like some like I don't know, like some like decently like high earning place. And I think it's like when you have this perspective, it changes like not only how you handle your investments, but also just like how you like live, like how you think about money. This is
right? True. I think it is very helpful when like basically you're like not concerned about being able to pay the bills like for the rest of your life. You're kind of thinking about how do I create value, which kind of brings us to speaking of call options and value creation. So you left trading and you're now in the startup AI bubble. So I guess like do you want maybe talk a little bit about what you guys are doing now and kind of why you have like the level of conviction in what you guys are doing right now?
Absolutely. So about like a little over a year ago, like I left trading and joined Coolant, which is the startup that I'm at right now. Or very early, the seed stage startup. Cool. And actually, like at this time, like when I first joined, like a lot of the reason is because I think my heart was always in climate tech.
Okay.
Or in a lot of these like geospatial like applications. Yes, I love trees. Of computer vision, right? I had worked on a lot of similar things in college, like before I went full time in trading, things like that. And I think that this is just like what, like for one, like from research perspective, it's like what I felt was like really interesting. I was always interested in vision. I was interested in like a lot of the like I think it's also like a great time. Right? There's a lot of like very cool like frontier research that's happening in vision. It's not quite like as like developed, like as cracked open as like NLP has been yet, right? And also like I think this was just like application wise like what I like really cared about. And so I think it made a lot of sense. Whereas like now like a lot of sort of the calculus of this is like pricing, like what do I think I'm gaining, like what is the value that I'm getting, like monetarily, learning from like also just like I guess like how much fun I'm having at like a quant shop compared to like at a place like this.
This makes sense, yeah.
Right?
Yes.
And it's just like I think the work like I basically just get to do like 3D vision research. Like it's very cool. It's like like very appealing.
Maybe just for context, what exactly does the company do? How does the company generate shareholder value?
The most important question.
The most important question.
Oh
How's shareholder value being created?
Yeah. So basically, what we do is we scan trees.
Okay.
Which is very, very unique company in this day and age.
Okay. So you scan trees. What do you do with the scans?
Yeah. So we'll take a drone, right?
Yeah.
It's just like RGB imagery. We'll take a drone. We'll fly over like forests, things like this, and then create 3D reconstructions. And so there's already like a lot of like 3D vision that's set to create these 3D reconstructions. Like there's like a lot of like pipeline on like for the research on this sort of pipeline. And then after we do this. We have these like big data set about the natural world, these like sort of like these digital twins about the natural world. And then there's actually a lot of clients there that will care a lot about the metrics that we can provide them about this.
Okay.
So one example of this might be like a timber company, right?
Okay.
So if you're a timber company, like you manage a lot of land, it's actually very difficult for you to know anything about your land. The way that right now, like a lot of like how they're going to get a lot of measurements, like how are their trees doing, like how tall are they, how thick are they, how are the species? There's a lot of competition.
Okay, that makes sense.
Yeah, right. It's like they're going to send somebody out with a tape measure.
Oh shit!
And they're gonna go measure the tree.
I see. Okay, I see the nature of the issue with that.
So you can imagine.
Yes.
You can imagine like it's very slow, it's very costly, and also they're only sampling like maybe like one plot every few acres, and it's like one tiny plot.
Quant trading interview question: how many samples do you need for a certain level of statistical significance?
Exactly, right. Yeah, great question. The square root law is coming in again.
Yes.
But literally exactly as you mentioned is like this is like very like they sort of like do the statistical like modeling, right, where it's like a sort of like a small area estimation question of like based on these like few plots, like how good is your sampling? And the answer is like it's pretty terrible. Because like there's like huge distribution shifts across different areas, right? Like there's certain like if there's like disease, it's like usually like it could be like very localized, and in fact like you want it to be pretty localized, and you want to catch it when it's pretty localized, right?
That's true.
Like if there's a lot of species competition, like with other other whatever like vegetation, it's like that could be very like localized things, right? There's like huge distribution shifts. Like it's very inaccurate to do this, and also low-key like it's like not that accurate either. Like when they like go measure things, you don't actually know how tall. Like you can't measure the height of a tree very easily, right? You just kind of like
can't climb on.
So you can like shoot a laser pointer at the top and try to do some trig or something. This is like very like it's very like archaic, right? And so there's a lot of value in us like being able to like create these 3D reconstructions that are like literally centimeter level resolution. Like we'll know like how thick your trees are, how tall your trees are, things like within like an inch.
You get this with drones or satellites?
Yeah, it's purely with drone. Yeah, it's purely with drone, it's purely with RGB. There's been like some people have tried to do with satellite where you can do something statistical as well, right? Where you try to aggregate it. But we're really trying to literally measure every single tree. And then have different like vision models that can just like tell you specific information about the counts, the species distributions.
The forest, what do you call it? Group of trees.
Yeah, sure, like a stand.
A stand? Oh, like the trees managed by these timber companies. It's like surely it's like a very large area of land. Like is the drone like being manned by a person, or is it like kind of just AI control? Like how does it actually fly through this whole?
It's all like, I mean, it's pre-programmed, but it does have to be managed by a person.
Okay.
It is like the FAA will not let you just like send a drone out there.
FAA regulation.
There's a lot of drone shit happening in this country right now, where like all the drones are being banned because of like Chinese spyware and shit. So they're very careful about their drones.
Okay.
So yeah, there does need to be someone like out there flying, but you can still imagine, right? It's like with one drone you can cover like hundreds of acres.
Fast, yeah.
Like versus like if you compare that to just the rate at which like someone's taking a tape measure and like measuring your trees, it's not really the same scale.
The same order of magnitude.
Yeah, exactly. And there's like a lot of different like purposes you can imagine for this, right? Where it's like there's like a lot of like different like timber companies, whether it be like people that are in like carbon markets, planting trees for like investment reasons like this, whether it be like wildfire reasons, like coastline management reasons, things like this. And another benefit is that like we just get like a lot of data about the natural world, right? Like we have this like massive proprietary data set, which like in this day and age, like we all know how, the edge that provides.
That makes sense. Yeah. I guess I think we were talking about this a little earlier. This like interesting idea of like potentially financial instruments that make sense in theory and that you have engaged in, but we don't currently have. You want to talk a little bit about the idea of lifetime leverage swaps, P&L swaps?
Yes.
And why you're a fan?
Yeah. This is something that I've done with some of my friends, especially some of my very risk-seeking friends that like to take a lot of like high variance bets. Is that I have a few like lifetime P&L swaps. So it's like there's like some expiry date, right? And we will.
How do you guys set the expiry? Is it 20 years, 30 years? What are you usually using here? 40 years?
It's just whatever we just vibe. Like it's not that serious.
Vibe. Okay,
yeah, we just like.
You don't want to get. Is it not in a DocuSign? Be like on this date, liquid net worth.
It is. There is a date, but the way we choose the date is by just like how about your 40th birthday?
Okay, reasonable.
Okay. And it's like there's not that much.
Like for 20 years.
There's like not that much thought that goes into this. It's fair. It's like sort of a meme, but also sort of serious.
Okay. Fair.
But yeah, like, and then we will basically trade 5 bips of the difference between our net worth.
5 bips of the difference.
Yes.
What is 5 bips of, let's say, $1 billion?
So it's like 500K, right?
Yeah, actually, that is.
Yeah, right. And so the idea there is it's like, if you have like, for context, it's like I live in SF and like in a lot of these like very like founder, whatever, like startup type spaces, it's like everyone probably has like very high like mean expected net worth and like probably not that high median like net worth, right? And it's like a variance reduction mechanism, right? Where it's like there's clearly like this is like clearly a positive utility trade when it's going from like the richer to like the less rich person, and it's sort of like a bet on your friends like becoming rich.
That makes sense, and I think it's also you're low-key getting probably much more reasonable pricing than if you just like invested in their companies. Because I was thinking about this because I was part of YC, and then I did they do encourage people to invest in each other's companies as well, which diversification makes sense. I think on average it's like if you just blindly invested in YC companies, you had like an internal rate of return of like usually like 20% over like the last like 7 batches or something. So like pretty good. But then like now I'm looking at this, I'm like, do I really want to buy this at 40 mil cap? and then I think it's also like a lot of the big tech companies have caught on to this, whereas like it's also an imperfect hedge for like their like net worth, because it's like there's cases where the founders get hired for like a 100 million pay package, and then the company just like disappears, investors get nothing. But in general, I think directly I do agree that
right. You're getting the most direct exposure to like making. If you have a really smart friend, you want to make a bet on them.
Dude, I think it's like if you went to a good college or even if you like went to a good high school, obviously I feel like potentially that's like a place where kind of earlier in life, you have less information about what the people are actually going to do. So that also even makes more sense for kind of more uniform pricing. Whereas obviously in 40 years, people, like it makes less sense to do like swaps.
Yeah, right? Because in like 40 years, like everything's a little bit figured out.
All the risks have like already realized.
Yeah.
You definitely want to, hedge it when there is like risk to realize, yes.
Yeah, exactly right. And I think it's like, especially like if you're in like trading or something, or like you're in like one of these like if you're like a lower risk person, it's probably like especially good for you to do this.
Oh yeah, because you're getting
like,
call options. The lowest it could go is 0. So
yeah, whereas like if you have to give, like it's not that bad to give up your like 5 bips,
yeah,
right?
5 bips. Especially if you think about like your portfolio, if it's like even if it's just S&P, it's gonna move a percent.
And also you're giving, like you should be you're giving it to your friends. You should be happy.
True. You should be happy. You should be happy. And dude, I was gonna say like even if you had your liquid net worth in the S&P, it's like what 16 vol product is still moving like 1%, like literally 100 bips.
Yeah.
Like you should not care about 5 bips. Yeah.
Yes. But yeah, I think that I'm a big fan of these contracts. If you're like
hopefully
have the privilege to like
one
to
day
do
we
something like
have
that.
Sam Altman's world coin where each person's identity is attached and you can make real on-chain swaps.
I don't know about hopefully, but maybe. But if this happens, you might have to think about it.
Dude, they can replace so many insurance contracts. Yeah. Cool. Thanks for coming.
Yeah, thank you for having me.